I'm Shweta Kothari. We're bringing you stories from the world of business, policy and economy. In the studio with me, my colleague Suyash Maheshwari. Suyash, good morning. Markets opening in green this morning.
Yes, markets witnessed a strong start to the week with Nifty opening above the 19,800 mark. Now, this is on the back of a positive handover from the US and European markets. Now, US markets closed with significant gains. All three indices, the S&P 500, Dow Jones and Nasdaq posted gains of about 1% in yesterday's trade. European markets were buoyant as well. Asian markets also opened in the green this morning. Now, this is also like the Indian markets are also witnessing a surge because Brent crude has softened slightly. It has fallen below the $90 barrel mark amid reports that, perhaps US is going to lift sanctions on Venezuela. So that has eased prices or oil prices, and which has also given some sort of strength to the Indian markets. Now, currently the Indian markets are trading above the 19,800 mark. Sensex is also up about 300 points and is sitting at 66,500 mark. The broader markets, Shweta, are also buoyant with Nifty small cap index trading 1% higher and the mid cap index trading about 0.6% higher. Now, talking about sectors, all sectoral indices barring Nifty Realty are in the green this morning. Now, both Nifty Bank and Nifty PSU banks are trading with good set of numbers. Like Nifty Bank is up about 0.6% and it is hovering around the 44,500 mark, whereas the PSU banking index is up about 0.75% this morning. Other sectors that are in focus this morning are also the Nifty Metal Pack, which is up about 0.84%, Auto Pack, which is up about 0.5%, and the FMCG Pack, which is also up about 0.5%.
All right, that is as far as markets is concerned. Let's quickly get in Ambareesh Baliga joining us on the show at this point in time. Mr. Baliga, thank you very much for taking time out. It's a bright start to a Tuesday morning. Markets up 0.5%.
That's true. I mean, the markets have been on a roll for a while now. Despite the Israeli conflict, we had the fall for a day or two. But then after that, I think liquidity has been driving the markets up. And this is despite the rupee turning a bit weak. Oil is still a risk. Although we have seen oil correcting to a certain extent, but that still remains a risk. So as of now, clearly, I think it's liquidity which is driving it.
Okay, liquidity driving it. Suyash, talking about liquidity and talking about crude oil prices, crude oil is something we've tracked very, very closely here. Does it look like worst may be over for crude oil just as yet? I'll take that question to Mr. Baliga also. Mr. Baliga, crude prices inching up gradually, slowly. There are fears that it will head towards a $100 per barrel mark. Hasn't happened so far. What are the possibilities in your understanding that $100 mark will be touched anytime soon? Would you expect prices to ease up now that we have seen perhaps the worst of what Israel war could have done or would have led to?
No, I don't know whether we have still seen the worst of the Israel conflict because clearly I think that will go on for a while. I think the only fear which could be there is whether it will broaden. Okay. If it remains at the Gaza conflict, I think that is, that's something which the markets could accept, just like how the markets have accepted Russia-Ukraine war, which has been on for more than a year now. So, in case it broadens, I think that's the only risk the markets have to look for. And in case it broadens, you'll see the oil prices climbing up.
Now, Mr. Baliga, the last time you were here when Nifty was hovering around that 19,500 mark, you made a bold prediction that, we could see perhaps Nifty slip to 18,500 sort of levels. Is that
before it scales up to 20,000? Yeah. We remember, I think just... yes, Mr. Baliga.
I stuck my neck out and said that possibly we should see 18,500 levels before it touches 20,000.
Would you still agree with that?
I would still stick to it. Because whatever said and done, the move which we have seen in the past few days hasn't been a very strong move. We have not seen too much of a participation. It has moved up, no doubt. That's clearly there on the figures which we are seeing. But then it's not really been a very broad move, and the participation seems lesser than what it was in the past. And like I've been saying earlier, the problem is not there with the Nifty stocks or the large caps. The bigger problem is there with the small and the mid caps, where most of the retail money is there. And that's where the volatility is huge. And in any sort of a correction, I think the retail and the HNI investors, would actually get affected the most. Because if you look at the large caps, yes, I mean, there are issues, but that's only in certain pockets. Like, for example, defense and railway stocks among the large caps. I mean, they have, I think they are too overrated, and the valuations are quite expensive. And that's where the correction would happen. But the rest of the large caps, the correction may not be too huge.
Okay. Before I let my colleague Suyash come in, we're looking at small caps and large caps still underperforming the headliners. Is the market already factored in what it could as far as small caps, mid caps is concerned, or are you looking at perhaps a further divergence from the performance of the broader markets as far as small caps and mid caps is concerned? Look at the performance today. Small caps up 0.94%.
That's to me.
Yes, that is to you, sir.
See, the small caps, if you look at, in those pockets where we have seen huge outperformance, I mean, so many of them have become multi-baggers. And after becoming multi-baggers, even if it corrects 10 to 15%, it's hardly anything. So when we talk of a correction, we're talking about a much larger correction. I mean, a stock which has possibly moved from 20 to 100, I mean, that falling to 90 is nothing much. But then when it falls to levels of 50, 60, that is when a lot of people get hurt, because most of the retail or the HNI crowd gets into these stocks after they have become multi-baggers.
Okay.
Just because the momentum is on. I mean, they bought it at those higher levels, and from there the correction is decently large.
So, will you advise investors, especially the retail investors, to be cautious as far as the small cap and the mid cap indices go? Because we have also seen volatility spike up lately because of the war that's playing out, because of the uncertainty that prevails in the global markets.
Absolutely. I think one has to be extremely cautious at this point of time. Don't go after momentum. I mean, unless you're a trader and you are used to keeping very strict stop losses and you actually abide by that, I don't think one should be trading in the small cap and the mid caps from an investment perspective at this point of time. Because like I said, when the correction happens, it can be huge, and that will hurt a lot. So I think one has to be extremely cautious, look at the valuations, because the way I see, I mean, across, especially, on the retail side, most of the people are not even looking at the valuation. People are just looking at momentum just because the stock is moving high into it. Yes, I mean, they are quite lucky at times because of momentum, they make money and are able to exit. But the problem happens when the exit stops, because when when the market start moving down, the liquidity is drawn out from the mid cap and the small caps, and that's the time they find it extremely difficult to sell. And also psychologically also, I mean, if you have seen a higher level, it becomes quite difficult for most of the people to sell at lower prices. I mean, if you're bought at 60, it goes to 100 and then comes down to 80, you find it difficult to sell at 80 unless you're forced to.
Now, Mr. Baliga, before we move on to stocks, also want to get your view on the banking pack. Now, Nifty Bank is trading with good profits today, like it's up about 0.6% above the 44,500 mark. And we have a lot of earnings coming from the banking and the financial space this week. Yesterday, we had HDFC Bank, Bank of Maharashtra. We also have ICICI Bank, Kotak Mahindra Bank lined up. So in light of that, do you expect that the banking index could show strength given that it has underperformed and make that dash to that 45,000 sort of mark?
I doubt that because like I've said in the past, I think the best of the banking pack, I think we have seen that in Q1 of FY24, which is last quarter. I think the NIMs have more or less topped out. I think the only space for outperformance could come from the slightly smaller banks where there has been a delay in terms of the earnings showing up. So I think some of the smaller private sector banks and the PSUs possibly may show a better performance in Q2 as compared to Q1. I think we've already seen that as far as Govt Bank is concerned. And I really don't expect the large caps, both in the PSUs as well as private sector banks, to show a better performance as compared to Q1. So if you're talking of the index overall, I really don't see a performance from here because, again, I mean, that is more heavy as far as the large caps are concerned, where I don't expect a performance.
Now that, you certainly expect the larger banks to underperform compared to the smaller banks, but what about the PSU and the private banking space? Which one will outperform this earnings season?
I don't think either of them will outperform. I think you will see pressure as far as the margins are concerned for both the large PSU banks as well as the large private sector banks.
All right. And since we're talking about banks, important to mention India's largest private lender, HDFC, came out with its results last evening. Suyash, run us through the numbers.
Yes, I mean, Shweta, having had some time to look at the numbers, sit with the numbers and read the management commentary, to me at least it seems that the results are better than what the street was factoring in, or at least better than, what the management commentary had suggested a month ago, during its analyst call. Now, before we talk about the numbers, it is important to point out that the Q2 numbers are not comparable on both year-on-year basis as well as quarter-on-quarter basis, because these results are of the are after the merger of the entity. So these numbers will not be comparable, and also both the banks like HDFC Bank and HDFC, the business model was different. So A plus B does not necessarily makes it AB, it could be C, right?
Okay, so let's quickly get in Mr. Baliga on that as well. Mr. Baliga, over the last 12 hours since HDFC came out with its results, we've seen comparisons being made in the media itself. Would it be fair to say that such a comparison is not warranted, given that this is a merged entity and you're talking about results of individual entities as of last quarter? Is there even a room for comparison?
No, I really don't think there's much of a room for comparison because 1 plus 1 here does not really mean 2, especially in the initial period when the merger is going through. Because end of the day, it's the people and the systems which are being merged. And typically in such cases, especially when we're talking about the larger companies, there is some amount of slowdown because there are changes happening within the system. So at least for 2 to 3 quarters, you'll see some amount of slowdown. So 1 plus 1 will be less than 2. But then post that, you'll actually see the performance happening. So I think one needs to wait for at least 2 to 3 quarters to really see performance from HDFC Bank.
Okay.
And the other thing which I would like to add out here is that always when you look at the quarterly earnings, it is always expectation versus delivery. So here, I think the expectations were set right by the management about a month back when we had the conference call. And the expectations are decently low. I mean, it was reduced, and because of which we saw the stock correcting also decently well. And the earnings were better than what we had expected. So that's one of the reasons why we're seeing quite a few of those positive notes coming from the brokerage houses.
Now, Shweta, let's quickly run through the numbers. Now, net profit came ahead of the street's expectation. The street was factoring in a net profit figure of about 14,780 crores. This time around, the profit came in at 15,976 crore, which means it's 8% higher than what the street was estimating. Now, net interest income came in lower, which by about 2.5%. The street was factoring in somewhere around 28,089 crores, whereas the number net interest income stood at 27,385 crores. Now, looking at the other numbers as well, the total loan book stands at 23.5 lakh crore, which on a pro forma basis is about 4.9% higher, meaning if we add HDFC and HDFC Bank directly. Total deposits, on the other hand, were up sequentially by 5.3% to 21.73 lakh crore. Now, net interest margin, Shweta, came in at 3.4% compared to the long-term average of 4%. Now, reading into the management commentary, the management said the dip was largely due to the higher cost of borrowing for the HDFC Bank, and over time, once the high cost debt is retired, the bank will replace it with retail borrowing, and then the NIMs will improve. Also, gross NPA stood at which came in at about 1.34%. The management said that around 22% of it of this portion is from the performing as well as they were reclassified as NPAs, but these assets are performing. So if we remove that effect, it's pretty much around the last quarter's earning. So I mean, as Mr. Baliga, you said that the results are better than what the street was factoring in, but I'm looking at this net interest margin figure of 3.4% versus the long-term average of 4%. After the management commentary, when do you expect that this normalization to happen? When do you expect the bank to finally get to that 4% mark?
See, this NIMS also fell because of the merger. And I expect, at least as far as HDFC Bank is concerned, the NIMS can move up a bit. I don't think they'll move back to 4%, but I think they can move up about, I mean, 0.3, zero point 0.4, maybe in the next 2 to 3 quarters. That's why I said I think we should wait for those 2 to 3 quarters to, I mean, for the performance to really show up.
And what's your take on the stock, sir? The stock is up about 1% this morning. It has been
Right.
consolidating around 1530 mark. So good bit of a movement there.
See, I mean, I don't see a major move in HDFC Bank, but as far as the like downside is concerned, I think that's over. So if one has enough amount of patience, then one could look at buying it at this point of time. Otherwise, there's no hurry to buy. But then, as far as the long-term portfolio concerned, this is a good stock to hold on.
All right, let's quickly also move on to another stock that we are tracking, Jio Financial Services. In fact, JioFin came out with its quarterly earnings last evening. Surprisingly, net profit up 101% quarter on quarter without an actual, understanding of what the business model is. How do you explain these numbers, Yash?
I mean, the 101% rise looks glorious, right? But let's break it down. Let's hold our horses there. Now, this was the first quarterly announcement from the company after its listing back in August. Now, the new company is yet to start the business. So, the numbers that are trickling in, at least as far as Q2 is concerned, is from its old subsidiaries, its associates, as well as its joint ventures. Now, if we look at the numbers, Shweta, broadly, the profit figure, of course, grew by about 101% on a quarter-on-quarter basis to 668.18 crore. Now, this growth was supported in profitability, was supported by a dividend income of about 217 crore and additionally a dividend income from associates of about 154 crore. But again, this 101% rise we are seeing, I was actually studying the financial statements released by the company, and one of the things that like caught my eye was that cash flow from operations, in fact, for the previous quarter was negative at around 132 crore. So the company is actually incurring losses from its operations. Now this is okay because the company is actually not doing any business as of yet. Now the profit that we are seeing of about 608 crore rupees comes from the investing activities, which is by the way of dividends from both associates as well as its parent company Reliance Industries. So Mr. Baliga, like, I mean, what sort of a weightage would you even give to the results of Jio Financial results? Is it a event for the stock, or is it a complete non-event, considering that we don't even know what the newly minted company is going to do going forward?
I think we have to take it as a non-event because it doesn't make any sense discussing the earnings of Jio Financial because there's actually no real business in the company right now. I mean, all that one is betting on is the group and the deep pockets they have and the sort of a disruption they have brought into retail and telecom. I mean, people are expecting a similar sort of a disruption happening in the financial services market going ahead with the Jio Financial. So as of now, I don't think these earnings make any sense at all because end of the day, most of the revenue is from dividends. And this was a dividend season, and that's why, I mean, that's one of the reasons why the dividends have come in. So I don't think, we should give any weightage to it. I think one should look at Jio Financial possibly a year or 2 years down the line if you really want to discuss the financials. I mean, right now it's a story.
Okay, and reading the management commentary, when do we expect operations to finally kickstart? Any clarity on, there's going to be, of course, a regulatory challenge, an insurance regulator, an AMC regulator, I mean, a whole host of regulatory clearances that the company will have to take. What sort of timeline are we looking at before the operations kickstart?
I think we should safely look at possibly Q2 of FY25 for the operations to really kick off.
Q2 of FY25, that's the timeline Ambareesh is putting to it. But while we're at it, let's also take a look at other stocks that we're tracking, Suyash.
Certainly, Shweta. So among the Nifty 50 companies, Bajaj Finance is going to also come out with its Q2 results during the day. Now, the net profit is expected to rise by about 30% on a year-on-year basis to about 3,600 crore from 2,780 crore in the year ago period. Net interest income is also expected to rise by about 30% year on year, and sequentially it is expected to rise about 7%. However, the asset quality as well as the net interest margins are expected to come under pressure, net interest margins, because of the higher cost of debt that the company is facing. Sir, I mean, we have seen a good bit of movement in Bajaj Finance stock. I think in the last 1 month or so, it's up about 7%. It also did a fundraising round where it raised about 10,000 crore or so. I mean, we have also seen other NBFCs, you know, come out with the fundraising. So,
I mean, they're shoring up their books. They are preparing for the competition ahead.
They have to, I think, before Jio Financial really starts their business, I mean, all of them will have to show their books and garner as much market share as possible. And talking about Q2, I think, the figures which have been released by the management earlier on the AUM growth of about 33% Y on Y, about 7.5% Q on Q, I think is decently
PVR?
good. Yeah, and I think, with this, possibly the earnings also should show a decent move. And because the momentum is there in the market, the stock can actually move up more from here.
Sir, I was reading at the brokerage views, like they have a target as much as 10,000 rupees. Now, do you expect that sort of an upside, like 20-25 upside from here on?
No, frankly speaking, in a market like this, it's quite difficult to really see as to where the stock can go and stop. But looking at the valuations, even giving it the best possible valuation, I really will not give it more than 9,400 to 9,500 levels.
And as far as the competition goes, who do you think will give Jio Financial the toughest competition? Among the likes of Cholamandal, Aditya Birla, Bajaj Finance.
I think the closest which can come would be Bajaj Finance. So I think the highest risk is also there for Bajaj Finance, because the way they have performed in the last so many years, and the sort of premium valuation which they're getting from the market, I think that could be at risk.
All right, that is as far as competition in NBFC space is concerned. Ambareesh, thank you very much, sir. Thank you for taking time out, for joining us here on News 9. But shifting focus now to a story that we're tracking by the way of production-linked incentive scheme. It appears that government is also trying to woo in more battery manufacturers by a way of a revitalized PLI. My colleague Karthik Malhotra joining us here in the studio. Karthik, there is a attempt made by the government here not just to set up shop in India, but to set up all kinds of shop in India, be it manufacturing, battery, semiconductor. There is an attempt, of course, being also made by the government to shore up its battery manufacturing facility through production-linked incentive. What sort of details do we have?
Yet again, in fact, I think the first ACC, the Advanced Chemistry Cell-related Battery PLI, was initiated in May 2021. 18,100 crore rupees allocated. Now, the point is, we don't have data yet on what has been the kind of offtake.
Right.
Now, the Union Minister for Renewable Energy, R.K. Singh, has gone on record to say that EV adoption in India is only going to go further if we have the cost of batteries going down. Now, cost of battery going down is directly related to batteries being manufactured in India. But it's been about 2 years and a quarter since the PLI scheme of 18,100 crores was rolled out, and we still haven't seen much EV battery production happening in India. Now, multiple reasons for that, Shweta. Number one, of course, is the fact that we continue to be dependent on lithium imports and lithium-based battery imports. Now, lithium, of course, is a critical mineral that goes into creation of EV cells and EV batteries. Now, I believe this new 1,000 crore rupees, which is likely to be included, this is not going to be the ACC segment.
Okay.
I believe this is going to be in the lithium-based battery manufacturing space. And it ties in well because in the winter session of Parliament expected from, the first week of December onwards, we should see the amendment to the Mines and Mineral Act also going through. Now, if that goes through, you do encourage private participation to engage in digging up the lithium reserves found in, supposedly found in Jammu and Kashmir. I think once the actual excavation begins, that is when we will know what is the quality of the lithium, how much of it is really available. But estimates suggest that we have enough to not just cater to our own domestic demand, but even to export.
Okay.
So another 1,000 crore rupees of PLI being added to shore up the EV battery space in India. But I think overall PLI per se has been a story with a lot of question marks. We've seen 1.97 lakh crore rupees allocated.
Can we say for sure whether it's been successful or not? I mean, a lot of people looking at the
numbers
here would wonder whether PLI story has given the results that India wanted it to.
So I think very difficult to really put a finger on it and say that, yeah, it's been a great move and it has delivered results, because also understand that any sort of manufacturing activity involves a longer time horizon.
Absolutely.
Right? So it's not a startup that you hire a bunch of people, you add some technology and
you
get great valuations and you get the ball rolling. I think in the case of manufacturing, everything from identifying land to labor to getting the technology, putting it all together and really getting things to roll out is a much longer time horizon. So 1.97 lakh crore rupees allocated towards PLI. I think semiconductor has been one sector, one industry where we have seen a great pickup. We've also seen companies based in the US like Micron and Allied Materials coming up and ready to set up their plants. In fact, the groundbreaking ceremony happened already last month with Prime Minister Modi only inaugurating it. And remember the deal, the MOU was signed when Modi was in the US. So some work we've definitely seen in the semiconductor space. In addition to that, I think smartphones has been a great PLI story. We've seen smartphones manufacturing, electrical components, electronic components manufacturing take off. But look at the flip-flop that the government has done when it came to IT hardware. So the PCs and the laptops and the tablets and their manufacturing, their import licenses, we spent enough time debating those, but again, you give some, you take back some, you roll out something, you reverse it. So I think the government has not yet been able to ascertain for itself whether it has got the right scheme and the right incentive mapped out when it comes to pushing manufacturing in India. And remember, the time is as opportune as it's ever going to be with this mistrust, distrust on China, with global supply chains hampered, with overall the China plus one narrative building up. And now another war. That war's impact, of course, is going to happen more on crude oil-based, inflation-based, discretionary spending cut impacting the IT sector. But overall, I think the time is opportune with China plus one heating up. India needs to shore up its manufacturing, and one way to do that is some incentive, some scheme which enables manufacturers to set up shop in India. But how much of that should be by way of arm twisting? How much of that should be by way of extensive paperwork and approvals and licenses is something that the government will have to recalibrate. And some report card of the PLI scheme needs to come out, because there are many sectors which are still demanding PLI. Toys being one. Textiles being another. Textile PLI was rolled out, but have we seen any action? Not yet. So I think a lot more action needs to be seen, and a report card of the PLI offtake needs to come out divided sector wise so that the government is able to understand, okay, these are the sectors we need to focus on, and let's not spread ourselves too thin and assume that all sorts of goods are going to get manufactured in India. I think that is going to be a far cry, and the government should realize that and recalibrate if required.
Absolutely. But for now, a new PLI for batteries, that of course is in the offing. But as far as shoring up India's internal capabilities is concerned, a story we're tracking by the way of rice, it seemed to have backfired a little, because remember, government had put up a minimum export price on rice so as to curtail the export of non-basmati white rice. A lot of exporters, rice producers, are saying that the MEP is hurting sentiments because they're not able to export basmati rice as well.
So actually two sides of the story again, Shweta. At one level, I think when the government had implemented the curb on exporting non-basmati white rice, I think the objective was very simply to cater for the domestic demand. And the fact that we were looking at double-digit inflation, and in the month of June, July, double-digit inflation on food prices going as high as about 19%, 20%, it was time for the government to intervene and say that essentials like rice and non-basmati rice need to first cater to domestic demand and hence curb exports of non-basmati rice. But Indian traders, Indian exporters tried to outsmart the government and said that let's package our non-basmati rice as basmati rice and export it. And then once the government realized that, the circumvention is happening by way of branding non-basmati rice as basmati rice, then the export curve on basmati rice also kicked in. So the government said that let's look at a a minimum
price
export
threshold.
price reduced from $1,200, which was per ton, which was for basmati rice, brought it down to about $975 per ton. Now, this was done to make export of real basmati rice a little less lucrative for exporters. But this apparently, as per a report in Reuters, now suggests that the government, in fact, in August had said that it is going to remove that restriction of 975 and let the MEP go back to its original threshold of $1,200 per ton. And that decision was supposed to be rolled out in the month. It was announced in August. It was supposed to be rolled out in September. That hasn't happened yet. So the government is still looking at watching food inflation in an election year, given the fact that energy prices in any case are likely to go through the roof. If oil production cuts continue and if the war escalates, we could easily look at a $100 per barrel figure, if not beyond. But the point being that that is going to have a direct impact on inflation, and food price inflation, vegetable inflation, and these essential commodities are going to affect everybody across the country. So the government has thus far not reverted from that $975 per ton to $1,200 per ton for basmati rice, and that is likely to hit exporters because while we have eased the export restrictions, the pricing, the floor price is still determined by the government, and that lower floor price suggests that exporters don't have too much bargaining power to sell their basmati rice at a price that they think they can command from the international market.
So from what I'm understanding, if a basmati rice exporter want to sell it at less than 900, they're not able to.
975 is the minimum price set by the government. This minimum price was earlier $1,200. So a major 25% reduction or so in the price that the exporter could derive by selling the basmati rice.
So they hold on to their rice exports, and as a result of which
or they sell at a cheaper price. So in any case, it is likely to hit them, hurt them. But again, I think we are in a position right now that that inflation could go anywhere, and even though inflation has come to a non-sticky 5% level overall at a retail level with strips of food and energy prices, we've also seen food inflation come down well within the single-digit range. So with this ongoing war right now, war on two fronts, Russia, Ukraine continuing, and the Middle East now, embroiled in this new war that we've seen between Israel and Hamas, I think the government does want to look at inflation very closely and does not want to take a knee-jerk reaction of letting business run as usual by increasing the floor price.
All right, but exporters, of course, are saying at the moment that we have tons of rice and we're not able to sell it at a price that we would want the markets to command. So, of course, this is an ongoing tussle between the government and rice exporters. But shifting focus to, in fact, staying on with war and what war could result in, you rightly mentioned that we are at a cusp of, we don't know whether the war is going to further escalate, and if it further escalates, what happens? At the moment, immediately, Indian rupee has taken a hit. It has touched 83.28 against dollar, which is just 0.1% shy of its all-time low of 83.29, which means rupee definitely taking a hit at this point.
So rupee is taking a beating, not a very massive beating also, because what the RBI has done by way of intervening. Now what happens in a typical war-like scenario, especially one which is ongoing in the Middle East right now, is that, of course, we are talking about crude. So crude is the main sort of, export for the region. And almost all countries, including India, are importers of crude oil emerging from Saudi Arabia, emerging from the Middle East. And after the sanctions on Russia, India and China were among the only two large economies which continue to buy cheaper oil from Russia. But that's not the case for Europe. That's not the case for US. So US and Europe continue to be dependent on oil produced in the Middle East. Now, with oil prices going high, and in fact, Brent breaching the $90 mark yesterday, it has come down within the below the 90 threshold again. But with a $90 plus rate that it commanded yesterday, we've seen the US dollar index surge to 106.5. And this was an index which was hovering in the range of about 100. And we've seen that go up about 6.5% at 106.5. Now, as a result of that, US 10-year bonds are seeing higher yields at about 7.3%. Now, this has a direct impact on the rupee. Rupee as a currency becomes less lucrative. Now, what the RBI has done is it has intervened by selling as much as about $3.8 billion of its forex holdings in terms of US dollars back into the US. Now, it has tried to curb it because RBI says that if it had not intervened, prices could have gone to their all-time low of about 84 to a dollar. So, rupee still continues to be at about 83.28, but more forex selling cannot be ruled out at this stage.
Okay.
Remember, again, I think it all comes down to the fact that we are in a run-up to the election season, and all sorts of prices will have to be tamed. Now, LPG subsidy has already been given, right? It is unlikely that rising crude prices are going to get passed on to customers by way of higher fuel prices. OMCs are going to take some beating on and will have to take the shocks on their chin. And at the same time, even the rupee devaluation against the dollar is going to be bad news for investors looking at parking their money in India. So, it's both the fiscal policy and the monetary policy will have to work in sync with each other at a time when any sort of negative data emerging from India, any sort of pressure felt on Indian stocks, Indian treasury bonds, or the G-Secs as we call them, or even inflation numbers which could have a direct or indirect impact on GDP. Any negative narrative emerging from India could spell bad news for FII investments into India and not spell good news for election year coming ahead.
All right. And what is the immediate impact of rupee depreciation on consumers in India? I mean, for one, it becomes difficult for you to go out, not just to study, but also to on a vacation, on a holiday. All of that impacts consumers.
Yeah, of course. I mean, for affluent consumers who want to travel abroad
or to study abroad,
then I think 0.2%, 0.3%, even up to a 1 rupee percent is not going to make too much of a difference, because how much are you going to go and shop abroad? I think your tickets.
And how about those who are wanting to go to study? I think that they take a direct hit.
Of course. I think anything. It depends on what socioeconomic strata you're from, and if you have the ability to study abroad, it is going to make a slight dent to what you eventually end up paying when you convert it back to INR.
Absolutely.
So, but otherwise, I think 83 is a level that we have seen and we have become comfortable with. A 30 paisa increase on that is actually not going to make or mar ambitions of Indians traveling abroad, either for leisure or for education or even for healthcare, which is essential for that matter. But overall, I think it is more a story of sentiment, more a story of headlines emerging that rupee is at its lowest ebb. Right. And that is bad news. And anything beyond 84, the mental threshold or the mental sort of makeup that, oh, rupee is now at 84, not in 83 point whatever decimals, is just sentimentally and emotionally not a great number to be at.
Absolutely. And just 1 paisa shy of its all-time low at 83.29. Rupee, of course, continued to take a beating. But since we are on war and the implications of war, one of the implications of war is misinformation, disinformation, and everything that is transpiring on social media has a huge impact on sentiments on ground as the war continues to escalate. More and more people are fleeing out of Gaza. 1 million people are expected to have already come out. In all of this, social media site X, formerly Twitter, has come under radar, Elon Musk specifically.
So, actually it's not restricted to Elon Musk alone, but given the character of Elon Musk, he happens to make headlines even on our show. But that notwithstanding, I think, all social media platforms, a lot of social media platforms, including Meta, which runs Facebook and Instagram in addition to WhatsApp, as well as X, formerly known as Twitter, and even TikTok, which has been banned in India since 2020, but
very
continues
popular
to very popular in Europe, very
yes.
popular in the US. All of them have come under attack by the European Commissioner. And the simple message from the EU to these US/China based tech giants being very clear that there is disinformation on your platforms, and that disinformation needs to be curbed. Now, remember, there have been enough litigations and enough rulings that have emerged where intermediary platforms will be held accountable for the content posted by the users. So this is all, at the end of the day, user generated content, but enough rulings in the US and Europe have come out against social media giants, telling them that it is your platform and you can't just say that I'm an intermediary and whatever somebody posts on my platform is not my problem. It is pretty much your problem. So So there were notices sent to X, to Meta and to TikTok last week, and 24-hour notice was served by the European Commission on them to take down content which is propaganda in nature, which is disinformation, and fake accounts of Hamas leaders and Hamas supporters, sympathizers, posting content, old content, fake content, and content without context, which is doing disservice to the news flow and is doing disservice to people's real understanding of what is going on in ground zero. Now, while Meta said that it has complied, it has taken down accounts, Twitter owner Elon Musk has also gone on record and said that multiple thousands of fake accounts have been taken down. But I think the case is peculiar for Elon Musk simply because this has come as a litmus test for all the decisions that Elon Musk had taken in October last year for about 3-4 months up until recently when the takeover of Twitter happened and the rebranding to X happened. What were some of those decisions that Elon Musk had taken? Number one, he had gotten away with all the blue ticks. Now, these blue ticks were verified accounts, real accounts of influencers, of journalists, of real people who had done some real reporting or real contribution to society, had been presented with a blue tick by Twitter saying that you are an authentic, genuine creator of content. Now comes Elon Musk and slashes down those blue ticks and makes it a revenue function, saying that you want a blue tick, you will reach to more audiences by virtue of the blue tick, but pay for it. Now, anybody who pays 800 rupees a month can, or $8 per annum as it is in the US, if I'm not mistaken, can get a blue tick. And that message or anything posted by that account can reach millions of more people. Now, simply put, I think getting rid of that verification and making it a revenue function is being put to litmus test today.
Absolutely.
That how do you now authenticate who is a genuine creator of content and who is somebody who is a fake spreader of misinformation, disinformation.
Somebody with an ulterior motive, somebody with an agenda.
So you pay 800 rupees a month equivalent and in dollar terms and you get that blue tick, you reach more people.
I think one of the decisions of Elon Musk that stood out for me after taking over was getting rid of the fact check division.
So that was the second point. So the fact check division completely dissolved. Now the point is, who checks facts
and
on the
who's
platform
responsible for the authenticity?
So one innovation that Elon Musk had done was that get users to report fake content. But users posting fake content, some users debating whether that is real or fake content, and no real internal safeguarding mechanism at X to ensure that the content which has gone there is actually fake or fact. So these two decisions which Elon Musk had taken soon after taking over Twitter and then rebranding it eventually to X are now undergoing litmus test, and I think it is going to be absolutely crucially, critically examined, watched by EU and by the US, and should be paid some attention in India as well, where social media owners and social media platforms are actually held accountable for whatever they play.
Absolutely, and people who are basically allowed to use these platforms to propagate their ideology, their agenda, which has real world repercussions, as we are seeing playing out in West Asia. But moving away from war to Netflix, we are given to understand, is hoping to shore up its revenue. I mean, the crackdown on password sharing has resulted in addition of 6 million more subscribers to the ad-free plan that perhaps you and I are subscribed to. But in addition to that, Netflix came out with an ad-supported plan, which is giving it better revenues, as a result of which we're now given to understand the ad-free plan, prices for which may be hiked.
So interesting commentary coming, especially in a week where Netflix is going to announce its Q3 results, and in addition to that give some sort of a guidance for Q4, and it follows the Jan to December calendar, which most companies do in the US. So I think that commentary is going to be critically watched. From what I understand from this overall situation is that at some point streaming platforms are understanding and realizing and appreciating the value of ad revenue, which was the traditional business model for all media, including social media, including YouTube, including TV channels, that ads are not history yet, and subscription will only take you thus far and not beyond. Now, what Netflix had done interestingly over the last 1 year or so, that crusade against password sharing, that crackdown on password sharing, would have, while at one level resulted in 6 million users subscribing to the SVOD or the subscription-based SVOD or VOD model, it must have seen that the ad revenue that it gets by way of just showing ads and getting this B2B revenue from advertisers seems like a better sort of business to be in. And hence, I think the news emerging now is that the ad-free plan, which was cheaper than the ad-free plan, may now be made a little more expensive. That let's get enough revenue from advertisers, let's get incrementally more revenue from those who subscribe to the ad plan, and let the subscribers dwindle if they need to down the line, because this is going to be
to ad plan as opposed to ad free
maybe
plan.
not push people, but those
Encourage
who are
them?
on the ad plan, who are in any case hooked to the Netflix platform, pay a little more, pay a couple of percentage points more, and shore up that side of the revenue business, the advertising side of the revenue business, a little more. And if you continue to add subscribers, great news. Even if that business dwindles, shore up this side of the business.
All right, but all in all, I think a victory for advertisers in all of this.
Not really, because I feel if more people were to switch to the AWOD platform,
which
or
is
the AWOD
ad-free
service, no, the ad-supported one versus SWOD, which is subscription-driven. If more people were to move to AWOD, that becomes a much larger user base, which means one advertiser's message is going to a larger set of audiences, and hence the spot rate, as we call it, for ads will only go up.
Right.
So
it reaches out to more people.
It reaches out to more people, but I think more cash out for advertisers and more inflow for Netflix. So overall, this entire management commentary likely to come along with its Q3 earnings and forecast for Q4 and perhaps for the next year, coming at a time that revenue will be shored up one way or another.
All right, but a new market for advertisers and a new revenue model for Netflix. One
but
that is not
the service is not in India.
It's not in India. I was about to mention that.
If it comes to India, are you going to subscribe to it?
I don't know, Karthik. Maybe. Why not? If it's cheaper, I will.
Okay, but you don't mind watching ads as
no, I mean, it really depends on how long the advertisements are going to be.
And whether they're skippable or not.
Yes, and if it's constant at every 2 or 3 minutes, maybe not.
Because Hotstar did that, Sony Live did that in India, and honestly, I think the experience was uncomparable to the ad-free experience that Netflix offered.
I think you like the ad-free.
I'm not sure I'm going to I'm going to reduce my monthly spend and move on to being an AWOD customer from an SWOD customer.
All right, but that is of course Netflix and its new business strategy to move people to an ad-based subscription model where revenue comes in by the way of advertisements, because it's making more revenue per user on an ad subscription model. But that's all we have on this show. Thank you very much for watching.
They picked my husband. He was tortured there for 2 years. He was enforced disappeared. We had no idea where he is.